Alright, today is Thursday, September 10th, and this is a post-market review for the stock market activities today. Here is the agenda of the day, and while you read it, let me thank everybody who is subscribing to the channel and pressing the like button and sharing these videos. This is the only way for the channel to grow, so thank you for doing that. With that being said, here we go. We have a red day again in the stock market. The Dow Industrial Average closing in the red, a decline of 405.89 points or 1.45%. The Nasdaq declining by about 222 points or 2% even. How about the S&P 500? Down 59.77 points or 1.76%. And moving on to the sector's performance. Everything closing in the red. It was a red storm. Today, we will not give any medals. However, the decliners are led by energy, technology, and utilities. And moving on to the futures market, and the gainers are OJ, Lumber gained about 3%, but I couldn't take the screenshot before the new session started. Oats closing in the green, corn closing in the green, building up on the shortage of supply, and of course, lean hogs exploding higher due to the increase of Chinese demand. And we had the news, of course, of the disease in Germany. All of these hogs have to be perished now, which will add to the supply crunch in lean hogs, and therefore you're seeing the prices exploding higher. Canola building on the gains for this week, and the decliners in the futures market. Crude recovered, bounced yesterday for a little bit, and now it is resuming the decline further, just like the stock market. And of course, copper taking it on the chin due to the reversal of the dollar. The dollar rallied just a little bit today, reversed, and copper took a hit. So did the stock market. I will demonstrate that for you when we talk about the charts. And moving on to the big casino, the options market. Let's see what's going on here. We are seeing softening in the volume and call options, which shows a little bit of fear, a little bit of caution here, but it is not enough yet. You see Apple leading the day, 2.3 million options traded today. About 66% of those are calls. Coming in the second place, Tesla, about 923,000 options traded today. About 55.5 of those are calls. Tesla is a different battlefield. I explained to you that the stock split is not good for Tesla because it will invite bears and shorts back to the name. And you're seeing more put activities due to the reverse conversion phenomena in Tesla shares. I warned you of that yesterday, and you will see massive swings up and down in Tesla due to the action in the options market. And at number 3, of course, Facebook, per usual, 528,000 options traded today. About 74% of those were calls. And now shifting to the headlines that shaped the day. And starting with the weekly unemployment claims coming in at 884,000 versus an expectation of 850,000. So we are beating expectations here in a bad way. And when you dig more and more, the most disturbing phenomena in the employment market today is the rapid increase of permanent layoffs. Furloughs are turning into permanent layoffs in a rapid manner. This is a very disturbing trend, and you hardly hear anything about it in the media. And of course, we know that the number of unemployed people is higher than the jobs available across all states. This is another disturbing picture showing that employers are not creating jobs fast enough to catch up with the rate of unemployment. And this is another proof that unemployment is going to stay with us for for a very long time, perhaps leading us into the stagflation phenomena if the Fed is not careful in controlling inflation. You saw Greenspan coming on today, and he said that inflation is one of his two biggest worries about the economy today. The other one, of course, being the budget deficit. And more proof of the upcoming stagflation in America, we saw the prices paid to producers increasing. And of course, the zombie pundits in the media are seeing this as a good sign of a recovery in the economy and an increase in consumer purchasing power, which is absolutely false. This could be due to price gouging from producers. Again, the laziness from reporting, they don't dig, they don't find the true picture of the report. Remember, tomorrow we have the CPI, the core inflation index, and that would be a very important number to watch. Because if we have an increase in inflation, yet employment remains low, and we're still not out of the woods yet, that would be a very horrible picture for the economy and for the outlook of consumer purchasing power, which means and correlates to weakness in sales for many companies during upcoming quarters. And moving on to the other piece of news, building on of what we heard yesterday about AstraZeneca pausing the vaccine trial due to somebody getting sick. One of the patients of the trial got sick, and now they put the trial on hold, and you saw that affected the reopening stocks yesterday. Today they came out and they said if we get the green light to resume the trial again, we can produce the vaccine by the end of the year. And of course you saw the reopening stocks, airline, cruises, hotels and casinos rallying in the morning today before they reversed along with the market. We will talk about that in a little bit. And of course, the whole stimulus bill fiasco from Washington, D.C., the circus going on over there. McConnell now saying there is no skinny deal. Everything's off the table. We're just gonna wait out till the elections take place. And the casualties, of course, for the indecision, all the political games are me and you. And the last bit of news, and this moved the market significantly, specifically for the names implied. Short seller Hindenburg Research released a scathing expose against Nikola Motors and its chairman Trevor Milton. To begin with, I don't know if the information of this expose, they took a short position and then they released the information, so they have an interest there, Hindenburg Research that is. But this guy Milton, Trevor, rubs me the wrong way. He comes out as a used cars salesman. And of course, he used corporate funds to install solar in his house and a lot of funny business. And now Hindenburg Research coming out saying that Trevor duped General Motors into the deal they signed a few days ago. Furthermore, accusing the company of fraud and staging their displays, that the technology is not there, and of course accusing him of nepotism, of hiring his own brother into the board. And of course this is a parallel of Tesla with Elon hiring Kimball to the board as a director. And we know that Kimball keeps dumping stock and getting richer in the process. And Trevor, of course, taking a page from Elon's book and practicing the same nepotism. Hindenburg also released some texts and emails which they paint as worrisome about the culture of the company and the merits behind their products and quote-unquote innovations. This was a very stinging report, and the gloves were off, and of course Trevor scrambled in the morning. He didn't know what to do. This caught him by surprise, and he came out on Twitter and he responded and he said, I know who's funding Hindenburg Research, and I'm gonna respond in a little bit. Give me a little time so I can go through all the accusations and figure out how I'm gonna respond. So we're waiting on his response, but this is a very interesting saga. My interest here, of course, is I'm a shareholder of General Motors, and General Motors took it on the chin today, declining over 5%. Now, why the hell would General Motors decline 5%? Because Nikola and Trevor are allegedly a fraud. The deal, General Motors got 11% stake in Nikola. They didn't have to pay a damn thing. They just got a stake in Nikola, and they promised the collaboration and the future production of the Nikola Badger truck. So the move in General Motors did not make sense to me, and my eyes lit green, and I scooped up a bunch of General Motors shares, adding to my current position. And now moving on to the heat map analysis. As you can see, it is a sea of red, with higher valuation companies getting hit harder, while value names, yes, granted, they got hit, but not as hard as the high valuation names. Case in point, you can take a look at Intel versus Nvidia, among many other names. And of course, we saw the gambling names, DraftKings, and some of the casino names rallying today due to the resumption of the football season here in the United States. So gamblers are coming back, hopefully, to sports and leaving the stock market. Let's hope that this whole correction and shakeout will scare the Robin Hoodiots and they will go back to sports gambling, leaving the stock market alone. We need a healthy stock market again. And that is not gonna happen with these morons in picture. And of course, you saw Tyson Foods rallying today due to the same news we discussed about lean hogs. Shortage of supply, increased prices of lean hogs means good news for Tyson. And moving on to an update of the vaccine rotation trade. Here we go. Everything got whacked today. You see the red scoreboards in front of you. However, the picture was not like this in the beginning of the day. The names on your right hand side, the comeback stocks, were actually rallying in the morning before the market reversed altogether, hitting everything. Today was a red storm, a hurricane that hit everything equally. And of course, this is why I warned you from the beginning that the way we were gonna go through this rotation is by nibbling in certain names, not opening massive positions, because there are two scenarios on the table. Number one, a tech specific correction or a momentum / high valuation specific correction that would hit the names on your left hand side severely, and the assumption of course that the money that will come out of these names, they will act as an ATM and the money will rotate to the names on the right hand side, the comeback stocks, the reopening stocks, and you will see them rally. That is of course scenario number one. We have yet to see that for now. Scenario number two was an overall correction that will hit all market participants equally. The names on your right hand side, left hand side, the momentum stocks, the lagging stocks, they're all gonna get hit equally. Granted that the momentum stocks will see more losses because the moves they've done already. They're more susceptible to the correction. And for the look of it, it looks that we are heading that way, so be careful here. And moving on to the charts analysis, starting of course with the S&P 500, the SPY, and as you can see from a 15 minutes chart perspective, we almost reached the gap in this chart and we struggled to break and rally since then. And what you saw is a reversal from the gap, which is a very bearish signal, indicating more pain to come. And you saw that pain as the shares of the SPY started to cascade lower throughout the day from the reversal from the gap. And now, of course, the question begs itself. Is this going to be a double bottom? You can see from the 15 minutes chart that we have stopped right at previous support where shares of the SPY caught support and rallied. Are we going to see that tomorrow? That would be a bullish signal for the SPY, at least from the short term. I, however, doubt it, because a reversal from the gap when you had the momentum to break above it is very bad, very bearish, and I think we stopped at the support today because we ran out of time. And when we get back to business tomorrow or next week, you will see the SPY piercing that support and we will not see a double bottom. That is at least my take. And when we switch to the daily chart, you can see that bear flag formation becoming clearer. Of course, I did not expect that the bounce will only last one day. So we will give the SPY the benefit of the doubt that it could consolidate from here. We could see a green day tomorrow, back and forth, continuing next week before the slide and the flush downward, completing the bear flag. But bear in mind that the bear flag could manifestate itself as soon as tomorrow. We had a bounce for one day, we tried to rally a little bit today, we reversed, and we could flush down as soon as tomorrow. Overall picture, it is bearish. And moving on to the chart of the Nasdaq, the triple Qs, the technology sector. And if you've been following me on Twitter today, I nailed the action in the Qs to the penny. Here is the first tweet that I released about 10 minutes right after the action started today. And I said that I'm looking for a reversal. We got the reversal almost right away. And I released, of course, a series of tweets throughout the day indicating that we did not reach the gap in the Qs. We reversed before we reached the gap. That is an extremely bearish signal. We've also broken the 277.5 support, and we've broken the April trend. All of these moves were a sign and a signal for a big flush down. And of course, I told you that I'm loading up on the short triple Qs right after we reversed without filling the gap early in the morning, and you saw that that move was rewarded handsomely throughout the day as the Qs continued to flush down. So what do we have from a daily charts perspective here? We've broken the trend again. We're making the bear flag. The bear flag flush down is more clearer here compared to the SPY. Everything leads us to a very bearish conclusion. And perhaps the most important chart of the day is the dollar index. I released a series of tweets early in the morning telling you to keep your eyes on the dollar index. A reversal in the dollar index to the green means a reversal in the stock market to the red. And this is exactly what happened today. There was very good correlation between the charts of the Qs and the dollar index. And as you can see from a daily perspective, here is the reversal. Of course, we broke above the bear channel. We tested it. We went down, and we tested the upper line of the channel yesterday. And today we bounced from it, and we are heading higher. Higher dollar for now means a rush to raise cash out of the stock market, which is all bearish news for equities. And you can see from the 15 minutes chart of the dollar index, the reversal is illustrated right in front of you. And moving on to the TNX tracking the 10 years treasury yield. This is important because the last few days we had massive corrections, yet you saw the 10-year yield closing in the green, which is weird. You would think if there is a panic out of the stock market, there is a rush to buy bonds, at least in the short term, driving the TLT and bond prices higher and driving and adding pressure on yields downward. We did not see that in the last few days. Today was different. We saw yields reversing and flushing to the red, to the downside. This is a sign and a signal that we're about to head into a panic mode in the stock market. If yields continue to flush down, the dollar index continues to rally, you bet that the bear flag manifestation will happen in the SPY and the Qs. You will see these charts flushing down from the very, very short consolidation we had right after the first leg down. So keep your eyes open to the changes and movements in these charts. And now let's conclude the video. Here is the message of the day. Tuesday, we started in a big red day. Gamblers figured out they're smarter than the market. They will switch from buying calls into puts. What happened Wednesday? The market rallied, smacking them 2 nice smacks in the mouth and sticking a nice hot pie on their faces. So what did they do yesterday? They figured out, oh, this was a small correction. We're over it now. The market's rallying. Tesla's up 10%. Let's do what we've been doing before. Scooping a bunch of calls. And what do you know? Today they got another nice hot pie right in the face, smothered back and forth. And the message here, stop trying to play the market day by day. Have a longer horizon picture in your trading. At least a week, if not more. A couple of weeks ago, we saw the divergence in the Qs, 10% from the trend line. I said this is the signal to load up in the short triple Qs. I did that. Some of you did that. We took the ride down. We made a lot of profits. And then I called the bounce, closing all these positions, booking profits. And now we're looking to the end of the week and the signal the market will give us for the next move. If it is a bearish move, a continuation to the flush down, guess what? We will load up again on the short triple Qs. I already loaded up on some today, but we will load up more. We'll make more money on the flush down, the second flush down in the Qs. You gotta take it at least in a 1 to 2 weeks horizon. Do not trade day by day. You will get smoked. You will get it wrong, specifically if you're trading options, and you will lose a significant amount of money. Lastly, we have broken lots of important technical support, at least in the Nasdaq. Major support lines broken, the 20 days moving average broken, 50 days moving average broken, the trend is broken, and when you do that, you find yourself in a scenario of a flush down where you were talking before about the sky is the limit. Now the sinkhole is the limit. We don't even know where the bottom is. I see a big flush down imminent in the stock market, at least in the Nasdaq. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.